Good morning, everybody. Happy Friday. I can't work out if this week has gone quickly or gone slowly. I'm a bit knackered, I know that. Morning, Kay.
Good morning, Mr. Ryan. It's gone quickly, I can confirm.
It's gone quickly, yeah. It's gone quickly, except when it feels like it's going slowly.
Yeah.
One of those funny weeks. Right, I trust you guys and girls have had a good week. Hope you've made lots and lots of pips. We're nearly done, but we have a day left to go. So let's crack on through that and see what's going on and what's upcoming. We'll take a quick look at the data that was out yesterday. Get the right page up. Right, so it's the US pretty much continued the PMI theme that we'd seen through Europe. Softness in the market, or the now S&P Global PMIs, softer in manufacturing, softer in services. So continuing this theme that we're seeing across the globe, really, in economies. Some mixed results, as we mentioned in the PMI. Some saw services rise and manufacturing fall, and vice versa. But generally, if you're taking the major nations, there is signs of this weakness coming into the data. Jobless claims was also out as well. One I keep an eye on, this 4-week average. As mentioned yesterday, it is just starting to edge up a bit. When you look at the trend, at least in the short term, we're now seeing these moves come higher and higher. We've seen it before. We have had little peaks and troughs in this number. It is a weekly indicator, so not one you'd put your hat on, but we're just going to keep monitoring this trend up and see if it continues. If we start moving considerably higher, that's potentially going to indicate that we might start to see some softness coming into the jobs market. It's not as I said, a direct, one-to-one correlation with things like the NFP, but it's looking at the trend. It's like I look at the NBA to see what the trend is in certain things, and these little indicators can be a little bellwether, or it can give you an early indication that there's potentially a change coming. So that's something to watch in that one. As I say, not too bad on the rest of the numbers. Continued claims, there or thereabouts. The initial claims number itself, we're talking small differences in the numbers there, but it's this one that I'm keeping an eye on creeping up. Moving on to some of the data that we've got today. In Japan, we had some CPI data. No real change there in the numbers. Certainly no real pickup. So those who are expecting the Bank of Japan, or those trying to fight the Bank of Japan and their monetary policy stance, haven't got any ammunition there, apart from the fact that inflation looks to be getting stable, which again is something that the Bank of Japan wants. They want stable moves in prices. They don't want volatile moves or anything like that. They want a sustained path of inflation and a sustained rise in wages. So no real change, but inflation is still sitting there. It's not going down at the very least. Into the UK, we had some retail sales this morning. Some of them a bit worse than expected. Overall negative. A lot of the reason why the retail sales are dropping is due to the price rises in particularly food and energy and things like that. It's leading to the consumer to be a bit more selective in what they're purchasing. It looks awful numbers on the face of it, but it's coming off some pretty big gains previously. So again, it's feeding into the theme of weakness in economies, in particularly in the UK. Although not really any change in the pound on that. It still remains, a bit under pressure, but still sitting in its recent ranges. Looking at Italy, we got consumers confidence numbers. Again, softness there, although business confidence rose a bit. So again, another bit of mix and match between the different metrics within that. Germany's IFO came out, once again softer in different parts, weaker in others. The overall expectations dropped, but current conditions fell back a little bit, but beat expectations. So right now the situation doesn't seem that bad, although we've got a bit of a low bar there anyway. The main index down to 92.3, a small move, but again following this this overall mood that we're seeing within economies at the moment. That's pretty much it from that data there. We have got a couple of bits. It's not too busy in the US session. We've got the final numbers from Michigan. So we know what they were in the flash. There shouldn't be an awful big change. There tends not to be a big change in this revision, but something to keep an eye on, particularly those inflation numbers. We've got the 1 year inflation number at 5.4, the 5 year or longer term at 3.3. As we've heard from the Fed and Powell, inflation expectations are now high up the list of things they're watching. So it's going to be this and the numbers in the other consumer confidence data that we're going to get soon that will tell us whether the Fed is right or wrong about their path for rates. Last on the list is home sales, new home sales, one of the main data points in the housing market. Is it going to also follow the others, starts and permits, existing home sales? Are we going to see another drop in sales there? Again, I'm going to be looking at the prices underneath that. Are we seeing prices holding up? Are they going to change? I'm seeing a lot of talk in FinTwit and around the markets about the possibility. There's some metrics that are showing that price rises for housing is dropping. It's still a bit unclear because we still have supply issues, inventory issues for houses, i.e. the market's pretty tight. So until that potentially eases up and more houses get built than there are demand for, we may not see price differences change there. We might see price coming down. But on the flip side, if rate hikes start biting into affordability, that will be changing and we will see some prices coming down. But housing, as I've mentioned before, is a good indicator of where problems start to come in, and then we look at the consumer thereafter. Bit of news from the UK that we spoke about yesterday. We had the by-election. Boris's two constituencies that were both under his rule, if you like, both switched to opposition parties. There's been a lot of political hoo-ha as expected this morning that Boris, questioning Boris's leadership. We had the chairman of the Conservative Party quitting this morning. As I mentioned yesterday, the reasons for these by-elections were not due to performance. They were due to two members who were in place getting up to no good. One convicted of sexual assault, another one watching porn in the House of Commons. So not political reasons, if you like, why they lost their posts. And voters were always going to give the Conservatives a spanking just on the back of that anyway, irrespective of the political climate currently at the moment. But anyway, one of the things I have picked up from these by-elections is there seems to be a lot of political apathy from the voters. Vote numbers were down. The parties that took the seats, although they gained, they only made small gains. So it's more a case of, if you like, Conservative staunch or stalwarts not voting at all, rather than switching to other parties. So it's not a wholesale switch or protest vote in terms of going to other parties. In one of the areas, the Labour Party, they lost their share, or there was a lower percentage of votes for them, even though they took the seats. So there's some voter apathy here that politics is, while it's important, it's getting on people's nerves, and rather than vote for someone else, they're not voting at all. So that's one of the key things that I took out of that election anyway. But it keeps the rumblings of discontent going on for Boris and his party. So we'll see how that's going to play out. Again, nothing that's massively price reactive for the pound, but it still remains one of the pressures around the neck of the quid, and a reason why it won't move higher. Clay, I don't know if you've seen any or picked up any other headlines that I may have missed, or any bits and pieces you want to discuss, maybe the Japan CPI.
Yeah, no, not. Yeah, the Japan CPI came in again above, but then Amamiya, the BOJ deputy governor, spoke afterwards, saying that they will continue with their easing program. He does expect the inflation to stay around their target level for a while, but then come off again. The market reacted bizarrely because after I've looked at the the timing of the moves. After the CPI, dollar yen actually went up. And then it's only later during the night where it started to come off again. I think it must have been with yields also. And then this morning early we did that low in dollar yen 134. I was talking about the 134 4060 for a few days. Looks that has shifted just a tiny bit of pips lower. It's more like the 2540 zone. Where we now regularly see the beats come in, and we are in the meantime already trading back above 135, which probably has more to do with, well, again, to do with yields holding up and the S&P breaking above that 38 figure 10 zone. For the rest, I haven't seen much. We have a bunch of speakers out today again, but I don't think that there will be. Most of them have spoken anyway. From what it would be ECB, Fed, whatever. But there's a bit of a powwow going on again today. We also expect RBA's low to talk later, together with the Dick Windows. They are together somewhere, in my opinion. I forgot exactly where it was, or where it is. So we might get a little bit, perhaps on the Aussie side. On the ECB side, it looks to me like they are now going to. They've said enough that they are going to go gradual in July and then possibly ramp up the hikes afterwards. But I think their emphasis now, they found their new toy to talk about, right? I think they are going to talk about this fragmentation tool more and more often, and the market may react smalls to it, but until it's up and running, I don't think we should really trade that one, to be fair. But for the rest, I haven't seen much else coming out overnight.
No, I think I was looking over the charts just before, just I was putting the bits and pieces together for today's show, and it's another one of these situations where we've been all around the houses and ended up back at square one. I mean, look where we were closing up last week in dollar yen, round about the 135 area, and here we are Friday 135.05. You can go through all the charts. Looking at this, euro dollar, we're a bit softer, but we're not too far away from where we were. Where did we close up there? Talking, round about the 105 mark, as I say, and we've been up and down, and we're 40 pips off. The same in cable. Here we are, right around the areas that we were, and it's funny because you go through the week and you get involved in all the price moves, the breaks in dollar yen and prices up and prices down, and it looks like you're busy. And then you look back over the week and think, well, what's changed over the week? What is different? And for a lot of prices, nothing, absolutely nothing. We're within 20, 30, 40 pips of where we finished last week. So what does that tell us overall? That tells us that for all the news that's come out, for everything we've seen, the data, the speakers, we're in a balanced mode at the moment. In FX markets, we're seeing balance. The market doesn't know whether it wants to go higher, whether it wants to go lower, and it's waiting for a catalyst to do that. Now, this comes even as we have seen some moves into markets. If we look at stocks, if we look at yields, look at yields for the week. US 10s, we've had a fairly significant move. We were well above 320 going into the end of last week. Here we are testing the 3% mark. So this is where things have changed. So what has changed here? Well, it's this mood that the market's in regarding global growth. They see that there's potential problems coming sooner rather than later. It's causing a repricing of growth expectations, a potential repricing of central bank expectations. We mentioned yesterday that the rates mob for the ECB, they cut their expectations from like 170 basis points of hikes by year end to 160. That was after the PMIs. Today, that's less than 150 pips. So these are things that when we look at the week, what has changed? What's changed is that the mood is souring for what's happening with economies. But at the moment, that's not really being affected or reflected in FX prices. So we're stuck in this period of potential ranging, and something we've been, talking about all week, that you can't sit here and buy the euro at 105 and think it's going to 109. You can't sell it at 106 and think it's going to parity, because the price action is saying, no, that's not what's going to happen. We can sit here and wait for it to happen, and trade it if it does happen, and look for the breaks and things like that. But for the most part, we're sitting in these ranges, and the best thing we can do is just try and trade the ranges, look for the big levels. I know it's a repetitive what I say here, but that's trading. Sometimes trading is being repetitive. It's having patience. It's not having over expectations on what the market can do or what a price can do, when it's clear as day on your chart what the price is doing. Where do I see the breaks coming from? I see the breaks coming if we get a sustained period of this souring mood. If we see more data dropping, if we see this recession noise picking up and that actually becoming confirmed, then we might get some of the breaks in FX pairs, because the weight will just become too much. It'll be bad for risk. Then we're going to get into, well, who's going to come out of it the best? And conversely, who's going to be affected the worst? And if you have to, again, put it in some sort of list from top to bottom, if looking at the majors, I still think the US is the one that will come out the best from it. Something like the pound and the UK is the one that's potentially going to show the worst of it. There's your trade right there. You're not going to be long cable if that's the outcome. Kay, what do you think of the mood this week?
Yeah,
do you think this is just small moves, or we're heading somewhere that's a bit darker than the place we're in at the moment?
Well, the thing is, I also commented several times already that we are building an inside ranges now. The main reason for it is that apart from the curve on the yields being constantly repriced and creating fast yield moves, yields are moving together across the apart from the yen, of course, but across the spectrum of major yields are moving together. And if yields are moving together with only minor changes in the differentials, that is going to keep flows either subdued, either as soon as we reprice something for the ECB, euro is going to come up from 106 to 105 or 104.70, but then the market stabilizes again, and then we are in those ranges. So to me, where it's going to come from is, yeah, as you say, rightfully so, where is a possible recession going to hit first? Who is going to be most dynamic to go into the recession and getting back out? That's a question for later. But that is probably going to cause the major moves. For as long as yields are moving in tandem, we can see that the US yields have been coming back from 3.20 to 3%. But at the same time, German and other European yields have been coming lower as well. The sterling yields, the gilt yields have been coming off as well. So that keeps the effects in ranges. And we also have to forget that, not forget that whatever happens, 80% of the time, FX markets are in ranges. Now, the question is define the range, but the 80% of the time, the markets are in ranges. Only 15-20% of the time, we are really trending in, strongly trending in markets. So we have to take all of that into account, especially now that yields are moving in tandem one with each other. So yeah, the next one is going to be. I kind of agree that the US may become out on top because it's one of the most dynamic economies. Europe is traditionally slower. Of course, now you throw Ukraine in the mix, you throw the gas problems in the mix. The supply issues in the mix, but the supply issues are the same everywhere. But Europe is traditionally slower, and they might see a more shallow recession as in the US, but the US will be more dynamic to come out of it as well. So Yeah, until then, until really we see divergences in growth data across the majors, I think we will remain in ranges for a while. I'm quite surprised how happy this the sterling is taking the whole thing. We did have the consumer confidence lower. We did have the retail sales lower. We did have the another loss for Bojo and one of his guys stepping down, and Sterling takes it really well.
Yeah, I mean, I think we've had a lot of the bad news priced in this move back at the beginning of July. You know, this theme hasn't just happened this week. You know, it has been ongoing. It has been a reason why cables come down from the 130s, just the negative mood that we've seen. So I think, yeah, you know, the markets only tend to price so far before they've had enough, and I think we're seeing a bit of that in the price action at the moment, where we're not really reaching for those lows. We are just sort of ranging around a bit. Trading wise, I'm still not keen to trade the pound, because you never know whether it's going to be up or down each 5 minutes. Even with the ranges that are looking in place, it's just a bit too volatile for me at the moment. I don't want to risk too much, because, you know, a 10, 15, 20 pip stop probably doesn't do you much good in this one at the moment, because it will fly through by 40, 50 pips and then come back. So this one I'm still leaving alone. But we are getting the level starting to develop, you know, around about the 121 50s, you know, purely on a short-term basis. 123, as we can see, was a level. Now it's cracking a bit. So maybe we're moving up to the 15, 20 area, you know. But as I say, you know, if you want to trade it and you try and keep it tight, you've got to be prepared that you might get a, you know, 20, 30 pip blow through before it then decides it's had enough and wants to come back again. Dollar yen, I had a lot of us, both of us, although me and Kay were looking at this 134.5 area, 45.50 area. And again, it's a bit unclean. You know, we had the breakthrough. It didn't show up as a level, really. So again, it's leading me to sit back a bit, see what develops. You know, is the level 30, 35 now? Is that where the number's going to come in? Or are we going to see a push lower? What looks definitive is, you know, that we may finish around where we started at the beginning of the week, but we have had some eggs cracked. You know, we broke the highs. We got up to above 136, towards 137. And even though the market's come back down again, we've cracked the egg. So potentially we've got room to move back up to these highs if the news dictates. But are we going to start to see some of these older levels then reinforcing themselves yet again? For me, I want to see a little bit more development going on here. I want to see more signs of a top put in. So another maybe test of the highs, confirm the prior highs. You know, then that will give me a bit more conviction that to trade against those. But on the downside, it may be that we need a bit more price discovery. You know, where's the number going to be? It's you know, we've got some levels further down, much further down, but it's a bit noisy in this sort of 135 down to 133.5 perhaps. That's what I want to see develop on the downside. And once we get that confirmation or I get that confirmation that ranges are developing, it just gives me a ballpark to play in. Then I can look to trade in between. Going over some of the other pairs, and then we'll look at the S&P. Let's go to dollar CAD.
The good thing,
again, another one. Yes, mate.
The good thing about ranges as well is that you don't have to pick a big side to be right. For people who trade intraday, ranges can be a blessing, right? Because you can be either you're long or you're short if you time it right, and if your entries are okay with compared to the levels that are in play. It's funny because in the market, it's not because you're short, that the other one who is long has to lose money. If you time it differently and you choose your levels differently, a range market can also be a blessing for short-term traders, because you can be long or short and still make money. Or one can be long, the other one short, not at the same time and not at the same level, of course, but they can, and they can all make money. That's what happens as well, and the beauty about the community we are in, because sometimes we have different views, but the one is going to buy dips, the other one sell rallies, and both make money, which is a great thing when we can define those ranges and trade them.
Yeah, absolutely. I mean, it happens often. Someone might be long cable off of a level, and the price jumps, and they're selling while someone else is selling and going short. There's always two ways to play a market, and you get sometimes these pattern changes. But in to a certain aspect, you can, if you're trading these sort of ranges and you're fundamentally focused like we are. Sometimes that doesn't matter. Intraday, it doesn't matter. Okay, we've hit a level. There's nothing, or I've ticked all the boxes to say I'm happy to trade that level, and it doesn't matter if it goes against my overall or longer term fundamental view. I'm just trading the levels, and that's my bias, my view on what happens in 6 months' time is irrelevant. It's a level. I'm trading it. End of. And I can even trade against my core positions. I'm long euro sterling. I'll happily go short if the level says that's what I should be doing as a separate trade. I've done it often because you shouldn't get stuck into your bias. You shouldn't get stuck into your marry a trade or a position or a direction. The levels are there to be traded. Sometimes I trade them, sometimes I don't. Looking here at dollar CAD, it's within this zone that we've got, that I've had on my chart since God knows how long. We're in the zone. There's your range. Break under 129, we're potentially heading lower. If we get above these 30, 70, 80 highs, we might get a test of 131 and the top of this channel going up here. That's all you need to do. 200 pips there, 129, 131, decent enough area to play in if you want to pick your areas. And wait for a change. Go with the breaks. Doesn't matter what I think of dollar CAD, oil, BOC, anything like that. Just trade the damn levels, as we say. Euro sterling. Mike wants to have a look at that. Not a lot to say here either. Again, another one treading water. We go up. We look like we're making a move above 86. Then it all runs out of puff and back down below we go. So, again, we look to trade the edges. We've got a little bit of a shorter term support area down here, but we've just, we've nicked through that today. So that opens the can up, that opens the door up a bit. Although we have got a little bit of bounce. But where am I sitting? I'm going to sit looking down here at this band, potentially looking at this band, but I'm more interested up at 87, 2.5, 300 pips to trade in between. And if I don't trade this noise here in the middle, then I won't trade it. I might get frustrated if I don't find opportunities I'm willing to trade, but that's part and parcel of trading. Sometimes you've just got to, let the market do its thing and have some patience. So if you, as Kay said, if you're a scalper and you're looking at this week, you trade the pivot around 86. If you're above 86, then you want to be long. If it's below 86, you want to be short, and then you pick your levels after that. And please throw us up in the comments if you want to look at some of the other pairs while I'm waffling on. Look, just picking some markets around. S&P is one that I wanted to look at, because here we do have a break, and if you're looking for textbook break of the techs, the 38.11 area was one we've been pointing out for a while. Let's get everything in focus. So, you can see what an area it was recently. We do get these moves above and below, but technically, we had the break below, then it held below. Now we've had the break, and as I say, in pure tech terms, it's a perfect break. We've had the break and had the confirmation, so now we're finding support into the area again. where can it go from here? You know, it's now only bumping its head, you know, 10, 17 pips higher, which suggests that it's not a strong break just as yet. It needs to do more. It needs to get a push on, you know, up to the high 38s, maybe tackle the 39s, that sort of thing. So at the moment, it's still a bit in the balance here. We can't break above these short-term highs after this big move down. So it's these small steps that prices need to take. And if they can't make it over these small steps, well, then you think, well, is he going to come back down? Is 38.11 going to become a bit pivotal, or just watch out as a level altogether? Just saw a question there for Artem. Can you please give some advice on how not to be stuck on bias? For me, it's hard to change direction of a trade. I know it's stupid, but it's still hard just to click the other button. That's a good question, Artem. You've got to be objective, okay? We can all have a view on where we think a price is going to go, what we think about the US, the Eurozone, the UK. You know, you can listen to commentary all day long, and everyone says the Eurozone is a failed project. The euro should be worth zero. It should go under parity. And people always tend to see the negative in things. And if you let that influence your trading, it's going to cost you money, because the Eurozone apparently has been a failed project since it started. And here we are, it's still going, and the euro is still going, and we're not at zero in the euro. But coming down from that, if you have a bias for a currency, if you think that a currency is going to do something, the first thing you got to be is objective. And rather than find reasons why you're going to be right, question yourself. What I think this, but what if I'm wrong? And what would lead me to be wrong? Now, I can be very strong on my views on where I think the US is going, where I think the UK is going. But when I trade, I try and keep it as balanced as possible. I want to think of both sides, not just the stuff that feeds my bias, that makes me feel I'm right. I want to know, well, if I'm not right, what are the reasons why I might not be right? And then when you get that into the mix, that objectivity where you try and see both sides of the picture, doesn't mean you change your bias, but then that will influence how you trade. Okay, so if you think the US is going to be the greatest economy on the earth, and you want to be long dollars, okay, well, there's things happening that say right now that might not be the case. Look at a pair like dollar yen coming off the highs. You think, well, do I want to be long dollars right this minute? And so that's how you change your bias. And that's why I can trade both ways, even though I have a particular bias, because no matter what I think, the price action is king. And that tells me what is happening at any particular time. It tells me what's happening over the longer period. And we touched on this week, you know, looking at the different time frames to get a view of the picture in the longer term as well as the short term. And that's how it influences your trading bias. But if you're in a position purely based on your bias and it's not working, and you're looking for reasons why it should work, that's the wrong way to approach it. You should always be looking what can go wrong. Why is there something happening that isn't making my trade or my bias go the right way? And if you ignore that, 9 times out of 10 you're going to lose money. Sometimes it just means you have to pause and think, right, I have this view, it's not working right now, so I'm not going to trade it right now, or I'm going to wait until the price gets to a level where I'm comfortable getting back in. But what you don't want to do is get stuck, get married to your bias, married to a trade that's going against you, when all the signals are telling you shouldn't be in that trade right now. So it's objectivity. You know, question yourself on both sides. How do you deal with stuff like that, Kay?
Yeah, I mean, as we have been talking already on the show about it, and probably on other shows as well, and in our chat room, I'm always bearing in mind a kind of a checklist of what's against, what's for, and the checklist can be relatively small when you do shorter term trading, and will get longer when you try to build on long term positions. but yes, there's always factors, price action, who, when you're wrong, you get out, because the first thing of a trader is to protect his account and always be able to stay in the game to do the next trade, because next opportunity will always come around. So not putting all the eggs in the same basket at any time. But when you're building on a longer term position, you're doing it differently than when you do it on a short term jobbing basis. Yeah, but as I did actually this morning, I mean, cable, I thought, or everything that happened overnight should weigh on the cable. I sold it a bit, went out straight away because the market didn't trade it, then went back in, and then, but that was only for short-term jobbing, and then it went down 25 points. I took part of them, and then I went out of sterling because there was no follow-through. But that's not a real bias. That's more short-term trading. But for the long term, you really should make a checklist and regularly look at your checklist to see if everything is still valid. If stuff is changing and the price action tells you that stuff is changing, that could and should at least make you reduce positions, or puts you in a position to possibly reverse it when the situation in the market reverses. But yeah. I mean, it's not a trading is not a science, right? We can't be 100% correct. It's not like 50 plus 50 makes 100. In trading, it's like 1 and 1 make 2 or 11 or 110. We don't know. There's a lot of uncertainty in there. So we need our checklist, and then helped by the technical analysis, and we really need to also stay disciplined. For me, the big thing is discipline. If you're wrong, get out, or if you're like, but it depends for every trader on how big he can go wrong before he feels wrong. Yeah. But that's, each individual has to find his way. But for the bias, it's not because you get out of a position that your bias has necessarily to change. It all depends what time frame you're looking at. But that's something we could be talking hours about, and perhaps we should be talking about this a little bit more in length one day, how to really manage a bias, and how not to blow up your account because you're stuck too long in a bias. We should perhaps talk about that a little bit later.
Yeah, I think that one of the biggest. Sorry, mate.
Yeah, can we perhaps move on to a couple of other currencies, because now he's talking about.
Yeah, I'll give you the charts in a second. I just wanted to say, one of the biggest things that traders face is admitting they're wrong. No one likes to admit they're wrong in anything in life. No one likes to admit they're wrong, and it can become a pride thing. You don't want to admit you're wrong. I'm sitting here, I talk in the public, I post online and in the chat room. I don't care if I'm wrong at all. If I say something and it turns out to be complete horseshit, fine. I'll be the first person to say it's complete horseshit. And that's what traders have to admit. When you're in a trade and it ain't working, and it's not working, damn well it's not working, but you're stubborn about it because you think you're right and you want to be right, that's when it'll cost you money. If you think you're wrong, you're wrong, get out, quit it, save your money, move on to the next thing, or to a point where you may be right. But admitting you're wrong is a big hang up for a lot of traders, and I think that's what does a lot of damage to people's accounts. Right, I'll hand over the ship to you.
Yeah, just
Mr. Man.
Just look at a few things.
Yours.
Yeah, just looking at a few things that I'm actually trading in and in it for the time being, and because we looked at the majors, and then let's look at a few other things. Do you see my screen, Ryan?
Yeah, got it, mate.
Alrighty. So the first one is Euro Swiss. As a lot of you know, I've been trading this short since the S&P and even before here. We're still we're in a gradual move lower, and it's pretty much respecting the levels pretty well. Now, for me, this 102.40.50 zone is a do or die zone. if one day it gets back above, I'm really going to reassess if I still want to be short. But in the meantime, I'm short the base amount, and then I'm adding on rallies into the levels, which I did again this morning. This 1:35.40 was a support. Well, not really a big support, but where people were buying, where there were clearly offers, and people were trading the range 101, 35, 40, 102, figure 30, figure 15. And now it seems that we have shifted a little bit short term anyway. So, but I'm still short. I still like it, and I think we could sooner rather than, well, sooner or later be in for a test of parity again in Euro Swiss, which is going to challenge the S&P and probably trigger a couple of reactions if when the Euro Swiss goes down to parity. Another one that I am in is this Euromex. It's a bit of a long time coming. Banxico raised 75 BPs yesterday. As expected, it did announce it kind of over the past few weeks. So we had what we were expecting. It does still put the mix well in front of the euro, in my opinion, as the one is 7.75%, the other one is still in negative territory. So I'm trying to defend a short euro mix position, which I took again on the break here. I'm in since 21.26, 6.5. I've been trading a little bit around of this level, still keeping some in, and we had this retest, and this morning again quite close to this 2109, 2110. I think that's the first little level to watch. We are again not too far. If that caps again, I think we could have a straight look lower over the sessions to come below 21. There's a few bids around 21 in my opinion. There's probably profit takers there after the fact. But fact of the matter is that, I mean, just for yield differentials, for as long as the global economy does not collapse, I always repeat when I'm in emerging markets, it's not because they have a 7 or 15% interest rate that they can't weaken. It all depends on economic conditions. Look at the Turkey. Turkey went up to, I don't know, 30, 40% interest rates, and yet Turkish lira lost 50% of its value. So it's not because a currency has high interest rates in emerging markets that it should strengthen. But MEX having been already resilient in the whole situation, I still think we might have some legs to go. I will reassess since I already took a bit of profit. It's going to be an okay trade still, and I'm taking the carry overnight. I will reassess if we get back above 21, 26, 27. The dollar MEX here is trying to break back under 20. Last time, for the more medium term, last time we had this fierce bounce of the 2017 red support line in the 1940s. I think there's a bit of decent support before, if we ever get down there at 1970-75. If we start to get back above 2010, especially above 2020, 2023, I think we need to be a bit careful with long MEX positions, because that should mean that there's something deteriorating in the economy. And then traditionally, because I know people are traditionally, I know people are watching this as well. Gold and silver, we are in the range. But since the yields, the U.S. yields bounced a bit, and the economic data coming out being a bit ish, gold is now struggling to hold those levels again, and I would not rule out a test of this 18, 10, 12. If it go below 18 or 5 or 6, there might be a washout coming. So I'd be a bit careful, but for as long as this channel and the range is valid, I'm not looking to do much in it, but I'd respect those levels. We really need to get back above 1850 to even get a chance to have a look at 1860 again. And this one is going to still be a big one, 1875, 1880 on the gold. Silver, same thing, bit of a washout this morning. I think a stop run under this 2089. We are back above, but we really need to recapture 21 to consolidate this 21-22 range again. If it goes below, depending on data, I wouldn't exclude it. You have to go back into the mid 20s for a starter. So a bit careful on the metals. What else? Yeah, perhaps this one, because I know some people are playing it in our room. We had a bit of a disappointing move, I must say, after the Norges Bank yesterday, and then it comes with a delay. Norwegian kroner is strengthening a bit. Brent is recovering as well. Brent oil is recovering as well. Yesterday as well, Europe signaled that they would likely ask Norway to help with their gas problem as well. So the fundamentals would still favor the Norwegian kroner in my opinion. So we went up to around 10 again in this dollar Norway and capped. So for those who wanting to play along Norway via the dollar, watch out if it break above 10.10. But 990 is a bit of the pivot. Below, we might see a move back to 975, and then 10 on the other side. If it breaks again, 10.10 maybe a bit of a danger zone. Euro Noki as well, low 950s. Low 1050s are putting a pretty decent cap on it right now, and we are starting to move lower again. For it to accelerate, though, I think we should break below 1030. And Ryan, that's it for me.
Yeah, thanks a lot, mate. Quick question from Anne. Is it good to go long AUD, Aussie, US? Right, well, come on, Anne, you know the drill by now. What's your reason for wanting to go long? We've just been speaking about bias. Are you looking at techs here? Have you got a bias to be long? Have you got a bit of a twitchy finger to be long your home currency? Give us a little bit of an idea what you're looking at. In the meantime, just looking at Aussie dollar, pretty much the same boat. We've got this weakness mood around the global economy. It is impacting commodities. You look at copper, you look at oil. We've seen a slump. Yeah, it's stabilized a bit the last day or so, but we've seen slumps in commodities, and that's not beneficial for commodity currencies. Now, this is all coming amid the Fed on a hike path that's potentially stronger than the RBA. That keeps the divergence in play. But we're not seeing a massive breakdown. So again, a bit like looking at the pound, where we get all the bad news factoring in, or the market looks pretty balanced at the moment. It's setting itself at a lower end, but really, we'd be looking at these mid to low 68s as the marker for what the market wants to do. If we start breaking below there, then we've got potential trouble on the cards. So if you want to be long Aussie dollar, these are the sort of areas you got to look at, because that's where you can pretty clearly define your risk. But look at the short-term trend. We've had the move down. It's stabilized a bit, but we're now just edging lower. So if we want to break higher, we've got to get above the 70 level. Right now, we're struggling to stay above the 69 level. So again, it's just about building up your picture. If you want to be long something, if you want to buy something, what's the price telling you? The price is telling you that we can't at the moment hold a move above 69, but we're not really willing to push the downside. So again, it's about, you know, exercising some patience, picking your points where you are more willing to trade. Would I buy it right here and now? No, I wouldn't. It's just not clean enough for me. And where would I buy it? Potentially on a break of 70. I would probably want to see confirmation of that holding, a bit like we've shown in the S&P, where it's broken a level and then you get a test and it confirms the break. That would be something that I would look at. But then for the top side, you know, we've got these smaller levels, these smaller steps in the way. So you've got to manage your margin here. You know, maybe take some profit on a break trade into this area here, or if you want to wait for this area up here, and then let the market ask the question: can we get above here? If we can't get above here, what are you going to do if you're long from 70? You're not going to wait until it drops below. You move your parameters up. So yeah, you know, I would look at again, look at the range, look at the 70 area as one point, and down into these 68 lows as another point. This is where you could get your decent support, but it's all about patience. So that's my thought on the Aussie dollar. Have you got any? Yes, mate. I know you're trading Aussie through other proxies.
Yeah, I think Anne was looking more from the short-term side. I know Anne is putting on daily, but he has support above 69, which is looks very, very short-term to me. On the hourlies, if you put on the hourly, there's a bit of a resistance line here. Yeah, right there from the 8th of June. Yeah, if you take the 8th of June around what is it, 72 and a quarter, and you draw a line there over the 16th of June high, and then the 21st. This line right now comes in at 69.20. If 69.20.25 goes, we may be in for a bit of a jump this afternoon. And on the other side, I see a small support, but that's really only from yesterday, the higher lows, which Anne was pointing at, in my opinion, and that support comes in around 68.90. So you've got a pretty tight range there to play with, Anne, if you want, on the really short-term side. I think if it goes back down below 68.70, it's bad news on the day for the Aussie.
Yeah, agreed.
Right.
Cool. Euro NOK just hit Richard's target a few minutes ago with that long squeeze. Nice one, mate. Like to see the pips going in the bank. Right, well, unless I can't see anything else on the list from you guys and girls that you want to speak about. So we shall call that a week. Thank you very much, as always, to you boys and girls for coming to the Flow Show and supporting us here. As always, please let us know if you have any suggestions, what you want us to talk about. I'm going to try and drum up a couple of people for some short interviews. I've got a guy in mind that I know who's more on the commerce side of the FX market. So I'm going to look to get him in just to give you folks a bit of balance. You know, the FX market isn't all about speculation. It isn't all about just making pips on price moves. There is an industry behind it. You know, it's part of the global commerce picture. So I want to get someone in to maybe shed a bit of light on that, so you can understand how this market actually works. So I'll look to do that. In the meantime, please have a great rest of your day and a fantastic weekend. Thank you very much for coming here. Cheers, Kay, and we shall see you all on Monday.
Have a great weekend. Thanks, Ryan.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.